Hi, this is G-Man Trading Community. We have come from far, my friend. Now we are in CFD trading. And from our previous lesson, we were talking about the history of trading CFD. And we have seen that it was started back in London in the 1990s. And it was used to trade by hedge funds. They used to trade shares, and the reason is because when you are trading CFD you don't have to interact with the real asset, and that was one of their benefit, and it was very very fast to execute. Secondly, you could short a market, which in the real world you cannot make any profit when the market is falling. So they could predict the market direction. When they see an asset will depreciate, then they could take that direction and make money. But in CFD, like you always know, is that someone has to be against your position for you to make money, because how do you make money if someone is not? So from our previous lesson you could see that the banks now came after the Bretton Woods collapse, and they took the same system, and now they introduced something else called pips and lots, which were introduced as a way of finding a way to measure the market differences, and they would set the amount of money would be bought at a particular volume. Yeah, so we'll see now about lots and pips in this lesson, which were some topics which popped out as we are going. So you would remember that lots stands for contract, and what I said about contract is that the reason it was contract for difference, those words were from the stock market, because at that time stocks were bought in contract. So one contract would stand for 2,000 shares of a particular company, and the next thing is difference. So they could measure the difference. So if it falls 20 cents, then they could multiply those 20 cents by the contract you took. If you had 5 contract, meaning that you had about 10,000 shares, so you multiply by 20 cents, you could see now the amount you could have maybe made in profit, or you could have lost. So now when it comes to bank, they introduced something called lots. When it comes to money, it is very different, and when it goes to something like an egg, it is a tray. Like you could see now, it's a representation of an amount. Make things simple in the industry, so they introduced something called lots. So the lots could stand for amount of money, and then something else, the difference in shares, now it changed when it came to money, is pip. So they introduced something called pips. Now this is what will be used to measure the difference of one price to the next, and this came for only for money. Before it came to even the rest of the assets, it was only for money, which was introduced by banks only, so that they could be able to trade with each other. So let's go, as from our previous lesson, 2 words popped out, which are lots and pip, and we said we have to start with the lots. So let's dive in. What is lot? A lot is a standard unit of a currency. So it's a standard unit of a currency. So inside a lot there is an amount of money that is there. So example, a tray is a standard unit of eggs. So one tray could represent something but it is in eggs. So you see how many eggs are in a single tray. So now this unit represent a number. One tray is 30 eggs. So one lot is equals to $100,000. So the bank had to introduce lots so that they could make things simple for faster execution. Mind you, you are opening a position and you have to put all these zeros that you need to buy. So it would be very very difficult. But now when you put just 2, you are saying that you have opened 2 lots, which represent $200,000. When you put 3, you represent $300,000. So when you are maybe trading eggs, for example, you put 10, you are talking about, so that is 10 multiplied by 30, that is 300 eggs, something like that. So this is a standard unit. It will is represented in lots, and the standard unit of a tray is 30 eggs. So let's go on. So this brings simplicity. That's why it was preferred, because of execution of trade position. It was simple. It would make things simple, so people could shout in the trading floor, I need 2 contracts. So someone will know that person is buying 4,000 shares, because one contract stands for 2,000 shares. So instead of saying amount of numbers, you just say lots, size, and it will be known how much you are talking about. So bank also needed a standard trading size. So traders would be buying random number. They needed something which was so simple. You could see these numbers which I have outlined here. We have 14,477, 51. So it will not be simple if you are dealing with these kind of numbers, but we needed round numbers, and the lots came to help. So, and one standard stands for $100,000. So trading needed a standard unit, so they created one lot. This was the only thing that was there when banks were trading, before even the retail traders like me and you. But we learn now how where we came and how even things get better in this system. So this became the institutional trading standard. They only traded in lots because they are moving a lot of money, because banks have a lot of money, billions and billions of dollars. So another thing is that originally only one lot existed. The only one lot, because the amount of money, they could not need another lower than this, because of the amount of money they are dealing with in the banks or in their system of ECN, which we'll learn later, the ECN system. So there were no other sides to the downside. So the participants were few, but the opportunities were spotted, and then retail forex arrived in 1990s to 2000s, and the broker introduced something called mini lots. So when an opportunity was spotted by retail traders, for them to earn a lot of people in the system, because now this is a spot market. I want you to understand something. This is spot market, which is used by the banks mostly. But now when it came to retail traders, they introduced what we will call mini lots to add some large number of traders in the market. So because in the CFD trading, when the market has a lot of people who are interacting, that means there's a lot of money which is be moving. People will be taking positions left, right, and center. But don't forget that the retail traders don't control the market. The market is controlled by the spot market, which are the banks and the big institutions. So the opportunity was spotted by retail brokers, which introduced another bunch of traders who would be trading at this something called mini lot. Mini lot was only the standard unit to be divided by 10. When you divide by 10, now you will see you have a mini. When you have now these are bunch of traders. So from 1 mini to 10 minis, those are trade positions and trade sizes until you reach, because if you multiply now this by 10, you will get this. If you divide this by 10, you will get this. That's simple. So that's how they will introduce a bunch of traders. Let's go on. And later they introduced something called micro accounts, micro lot. Micro lot users were now the minis will divide by another 10, you'll get 1000. So 10,000 divided by 10, you'll get 1000. So you need another 1000 must be 10 to make one mini lot. You need 10 mini lots to make one whole standard. So you could see now bunch of traders, a lot here. You can tell. So from 1000 to 9000, those are traders in between. From 10,000 to 100,000, those are traders in between. And they came even to nano lot. So from $100 to $900, you have nano lot accounts there, but they are normal. We'll see in the systems as we go to practical. So this was a milestone, because me and you, we couldn't have got the opportunity in this market. Now the formula used here is fraction with base 10 power. That's why I was saying it was just the division, so that you can add other people in the market. You had to divide by base 10 power or fraction of 10, so that you can get all those categories of traders, the minis and the micros. So the little brokers, they had to add all those people, because they need a lot of people in the market, so that the market could look liquidative. Because if there is no imbalance in their systems, now who would be paying the one who are in profit, especially when you short a position. So we need a lot of people to generate money, a lot of people to make mistake in the market, so that the broker could make even a lot of money, so that when you win, they have to pay. Before something called liquidity provider came. Let's go on. We learn who are the liquidity provider, because in the CFD, like we always say, there's always someone on the other side who's supposed to be picking your position. When you open a position, you pick the different position, because you are like a betting. So if I think the market could go down, then there's someone who would take the other opposite direction of my position. So let's go on. At one represented 100,000. With base 10, we can divide both sides and get all the categories listed above. So let's dive deeper, and you could see. So on standard lot is equals to 100,000. So let's divide 1. If you go even to your calculator, divide 1 divided by 10, you will get this. This is a mini of 10, mini of 1. So this is one whole. You divide by 10, like 10 over 10 is equals to 1 whole. So if you divide 1 whole divide by 10, you will get a fraction of 0.1. And then you go to the other side of money, which is representation. One standard represent 100,000, divide by 10, you'll get 10,000. So you can see. So the reason I have said that on the fraction side is the execution. This was what we see even in the systems. This what was even used in the trading floor. People could say, I want 2 lots, because this is the execution, instead of saying I want $10,000. So people used execution side as like this. So you could see now we need to bring, we have now mini lots. We can bring back micro by now taking 1 mini divide by 10. You'll get 0.01, which is the fraction and of the 1 mini, and you divide the other side with 10, you will get 1000. So this is the execution side, and this is the money side. So what would be representation? So 1 micro represents $1,000. And let's go to the next page. All these categories were traders added, after some time to make the CFD have more liquidity. And first to be added were mini lots. So still the volume was still low. So the second was the micro lots. Remember, in the CFD is not spot market. So if you pick a side on the asset, someone else is supposed to take the other side of your position. Like I have always been saying, someone has to take the other side, because this is not the real market. It's the shadow of the real market. The prices are, yes, they are real time, but the system itself is very, very different. So someone has to take the side of your opposite direction. Let's say you pick Euro USD, you sell. Someone has to hedge your position with a buy. If you get in profit, he loses. So if you are at a loss, he's winning. You get it? So it's either a broker or a lot of people or a big bank who are referred to as liquidity provider. So these are banks which now later they accepted to be used as liquidity provider in these systems of CFD, because now the broker could approach the liquidity provider so that they could not be at the middle of this happening. The only thing they could benefit from is on trade execution and swap fees, which we'll learn about them. But when it comes to a trade execution, those charges we learned them even when they were in investing systems. But in the CFD system, it's still the same, but you have to pay something like swap fee, something like that. So if the market has a lot of people, it is even simpler. And if the broker has a lot of money, it could take you a opposite direction. But this is conflict for interest. It attracts to other bad things which comes to happen in the market. And that's why I introduced my two brokers which don't participate in this kind of conflict of interest. They have liquidity provider. So they only benefit when you open a position or you close a position or a trade goes overnight. So they don't have any kind of conflict of interest. So they are not the one who are losing. They are not in pain. So that's one of the most important thing when you are picking a broker. And we will dive in those brokers and see what I was talking about. So now you know the lots, their categories. Next, we'll learn about pips as a distance calculator. We have learned about lots. And here I have some few stickers. So standard lot, which how they were introduced. This was used by only banks and is still used by only banks. But the rest are used by retail brokers. They introduced so that they could add a lot of people in the market to create liquidity. A lot of people could engage in this market so that when you open a position, it will be a faster execution. So there's someone else with a clear system ready to pay whether you are in loss or you are in profit. So these are the categories and there are lots. You could see standard lot, mini lot, micro lot, nano lot. So that's how they operate. Thank you very much. Let's go to pips as we go on with our CFD lessons.